Well, the final week of July is upon us, and it's going to be a very interesting week. Major financial events are coming to a head, which could influence the price of Bitcoin and the crypto markets. Will the markets shrug these events off, or will they be the catalyst for another bear trend? We'll find out in about 10 minutes, because it's time for Chico Crypto. Yeah, Bitcoin looked great last week, going on a bull rally from a low of 19K to reaching 24K by midweek. But that run petered out towards the end of the week, with Bitcoin retracing down back to 22K. Why didn't Bitcoin keep running? Well, because this week we have three major things going on in the traditional world of finance. Earnings for major companies are being released, the next Fed FOMC meeting, and finally US GDP data is being unveiled for Q2. So let's talk about each and how they could affect the Bitcoin price, beginning with the one on the top of everyone's mind, the FOMC meeting and interest rates. Rising interest rates, to be exact, which is a climate the US hasn't been accustomed to in a very long time. For a 2-year period dating back to early 2020 and for much of the decade prior to that, the Fed has pursued what is termed an easy money policy. This includes maintaining the Fed funds rate at a fairly low level and expanding the Fed's balance sheet on bond market holdings. As we can see from this chart, interest rates had been held near zero from 2009 all the way up until 2016. Then we started to increase. But the Rona hit and interest rates came right back down to zero in 2020, where they were held up until 2022. For a majority of Bitcoin's existence, it has enjoyed a climate of low interest rates. So how is Bitcoin performing in this much different environment when the Fed is dead set on raising rates? Well, back in March, we had the first interest rate raise. It was a modest one of just 25 basis points, and this came on March 16th of this year. So how did the Bitcoin price react during that time? Well, pulling out the price chart, we can see the price days before the announcement on March 16th, it deflated. But after it was announced, the price ran from just under 40K to over 47K. Why did this happen? Well, the markets were expecting this type of raise, but they were pricing in a higher raise and preparing for the worst, which didn't happen. So when expectations were met, the price ran. What happened at the next FOMC meeting in May? Well, the Fed decided to up their game. They raised rates by 50 basis points on May 4th. What happened to the Bitcoin price? Well, as we can see, the price increased the days before the hike, but after the hike was announced, down baby down, from 40K down to the 30K levels. Now, why did the price react like that time? Well, as we can see, the markets before the meeting were expecting a 50 basis point raise. Expectations were met. So what was the deal? Well, for one, no one expected this outlier, the Terra Luna collapse of $60 billion. It was a major contributor to the fall from 40K to 30K. But there was also this. Going back to the article on the basis point raise, we can see the Fed at this meeting detailed their plan for reducing their balance sheet, which also contributed to downward pressure for risk on assets. How about our most recent interest rate hike, just last month in June? Well, June 15th, the Fed announced they were going forward with another increase, raising interest rates by 75 basis points. How did the Bitcoin price react to this? Well, as we can see, leading up to the announcement, the price was retracing. And then when the announcement came, the price retraced some more, from 22K down to 20K. Not much downward pressure, but once again, the markets were expecting this, a 75 basis point raise. So when the expectations were met, the markets only reacted slightly downward. So out of 3 rate hikes this year, the Bitcoin price has reacted good with upwards movements once in March with the smallest hike, and bad twice. Large downward movements with a 50-point raise in May, which was exacerbated because of the Terra Luna collapse, and then a small downward movement with the 75-point raise just last month in June. So now that we know the history of this year's interest rate hikes, what is going to happen this time? Well, let's hear it from the bird's own words on what just may be coming. From homeboy Jerome Powell, Federal Reserve Chairman. He had this to say after the June raise.
We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting.
He doesn't expect 75 basis point raises to be common, although with this one in July, either a 50 point or a 75 point raise will be appropriate. No talk of a 100 point raise. So methinks that is totally out of the question. So what are the markets expecting? Well, Bloomberg covered this, a 75 point raise. And the article states, Federal Reserve Chair Jerome Powell is likely to slow the pace of interest rate increases after front-loading policy with a second straight 75 basis point hike next week, economists surveyed by Bloomberg said. So we are running into another big rate hike, of which the markets are fully expecting, just like last month in June. So many would expect the markets to react just like they did after the June hike, with the price pretty stable, only deflating a bit. Although we have things coming that we didn't have last June, like the Q2 US GDP data, which comes out on Thursday, the day after the interest rate decision tomorrow on Wednesday. And this is coming from the Bureau of Economic Analysis. And as we can see with the last reading for Q1, US GDP decreased by 1.6%. So what are people expecting this time around? Well, here is the thing going into this one. A second negative GDP reading will officially confirm the US is in a recession. A common rule of thumb for the definition of a recession, 2 quarters of consecutive negative GDP growth. So a negative reading would be very bad. Is a negative reading expected? Well, let's listen to Treasury Secretary Janet Yellen and her thoughts on it.
GDP will be closely watched. A common definition of recession is 2 negative quarters of GDP growth, or at least that's something that's been true in past recessions. When we've seen that, there has usually been a recession. And many economists expect second quarter GDP to be negative. First quarter GDP was negative.
He's expecting negative. So how negative will it be? Well, a trader Fortune on Twitter tweeted this. Atlanta Fed downgrades US GDP Q2 forecast, negative 1.6% versus negative 1.5% previous. US is already in a recession. Next week, the Fed will hike another 75 basis points into a recession, which will likely be officially confirmed the following day. The major risk for stocks is to the downside. Expectations are negative 1.6%, which would officially mean recession. And Trader Fortunes thinks there is major risk to the downside for stonks. So in my opinion, it is very probable the crypto markets will get hit worse than in June. But guess who is front-running the bad GDP data? The White House is. They put out this blog post July 21st, and it states, "What is a recession?" While some maintain that 2 consecutive quarters of falling real GDP constitute a recession, that is neither the official definition nor the way economists evaluate the state of the business cycle. Instead, both official determinations of recessions and economists' assessment of economic activity are based on a holistic look at the data, including the labor market, consumer and business spending, industrial production, and incomes. Based on these data, it is unlikely that the decline in GDP in the first quarter of this year, even if followed by another GDP decline in the second quarter, indicates a recession. So, the White House is changing the definition of a recession, as they know this will be a second consecutive quarter of GDP decline, which the White House doesn't consider a recession, but many top economists do. But that's not all. Remember I said it's earnings season. Over 40% of the Nasdaq 100 is reporting their earnings this week. and it includes top names like Apple, Microsoft, Amazon, Google, Meta, Qualcomm, T-Mobile, and Intel. So my friends, volatility is guaranteed this week. The only question is up or down? Well, most of you know my opinion. Get ready for the bears to take back control. Cheers. I'll see you next time.